Hi, I'm Eric Riscolo, market strategist at the New York Stock Exchange, and you are watching Taking Stock.
2 minutes to go here into the close for what is officially the first trading day of 2025. We are expecting here on Wall Street the final tail of the tape to be one in positive territory, but very much a series of major market indexes that have been trying to make up their mind here on this Friday, January 2nd. It does appear as if we will have positive gains for the S&P 500, the Dow 30, the NYSE Composite Index, as well as the small caps. It is historically a pretty strong day for equities. The NASDAQ has risen in 18 of the last 28 first trading days of the year. 7 of the 11 sectors in the S&P 500 set to finish this first trading day of 2026 in positive territory. Gains led by energy, industrials, as well as materials, with losses to the downside led by discretionary, telecom, and consumer staples. Welcome to the broadcast, one and all, our first official broadcast here on Taking Stock for the new calendar year 2026. A very happy new year to you all. I'm your host here at the big board, JD Durkin. Just mere moments away, my friends, from the ringing of the truly iconic closing bell, the first one of the new year. We got the team from NextGen EMP both ringing the bell. They will also be on the broadcast on this Friday afternoon. Volatility down, the 10-year Treasury yield up for a third consecutive session. Gold and silver benchmarks are up, as are the oil majors. The crypto majors are up as well. We'll talk a lot more about them. And the great Einstein of Wall Street will join us right after the bell for his take as we kick off a new year. Time now for the close here at the big board. And at least so far here in 2026, the major market indexes are undefeated in positive territory. We are one for one. Final tail of the tape on this, the second day of the year, but the first day open for markets here on Wall Street. The S&P 500 will finish up, let's call it 0.2%. The Dow 30 components having a strong session on the back of Goldman Sachs. Shares up there 0.6. The NYSE Composite Index up 1% and the small caps up 1% as well. Advance to declines telling us the tail of the tape. Very strong positive breath. Nearly 2 advancers for every 1 decliners. About 75 NYSE listed names reaching fresh 52-week highs. And technically every stock reaching a fresh year-to-date high, because it is, after all, the very first trading day of the year. Let's bring in the man himself, the great Einstein of Wall Street, the institution inside the institution, Peter Tuchman. Hello. What a way to kick off the new year. Thanks
Fantastic.
for being here.
Yeah, my pleasure.
Very happy new year. What did you look up and see today for the tail of the tape? Look at the S&P trying to make up its mind.
You know what? I saw a wild and crazy ride. It ended up well, but during the day, we always talk about we're one tweet away from crazy town, right? The market came in, a little feeling of a little bit of fresh money, right? And obviously the first day of the year, but we had a ride. There was at one point where we were trading up third. There was a little bifurcation. At one point we were down a couple hundred on the Dow and up 30 or 40 on the SPY. So something was you may know better than me, what was weighing on the Dow early in the morning. I don't know, probably 1 or 2 different names. And then it kind of flipped. They were both to buy. And then we were up 40 or 50 handles on the S&P, and then it just got whacked midday. Earlier midday. And I'm not sure what it was. We tried to find out what news came out on the tape. I'm not sure. Maybe it's just volatile. Maybe it's the first day of the year and everyone's trying to get their footing. But at the end we were sort of fighting the imbalances, because at one point we were too big to buy, $2 billion to buy. Market responded accordingly. It flipped to sell, right? And then we ended up flipping back to buy on the post. So this rally you saw was a function of $1.8 billion to buy that came in the last 2 minutes of trading. So what does that show me? That's fresh money coming in, people positioning themselves with billions of shares and dollars coming in on both sides. So I like that. Good breadth, as you said. Yep. 2-to-1 advances versus declines if you want to look in the nooks and crannies. And so overall, I think it's a great first day.
Yeah, we like to look at the nooks and crannies because the most consolidated, those tech names don't always tell the overall story with regards to breadth of bid under the surface.
Yes, for sure.
In your career, your esteemed career here at the big board, the iconic New York Stock Exchange, what do you look for in terms of volume or early year action that you'll be paying attention to as we come into Monday, which kicks off the first full trading trading week of the brand new calendar year?
You know what? Look, we have to see what is going to be the next catalyst. Are we going to head up? We have got a lot of landmark potential thresholds that we could be hitting here. Obviously, 7,000 on the S&P, 49,000, 50,000 on the Dow. As we went over this morning, you and I were on this morning, we talked about 2025 being an extraordinary year, and a resilient one, even though everything sort of was thrown at this market and we were able to get through it. Look, this is day one, right? One day does not make a market. We know that January, as you had said earlier, can portend what's going to happen for the rest of the year. Do we put all our nuts in that basket? I'm not so sure. But right now, we're looking to see what the follow through is on the interest rate cuts and the transition into a new Fed chairman. Then how is the energy sector going to look relative to all that demand that's going to be put on it by the AI sector? And then we're going to look at banks, and then we're going to look at the first quarter earnings that are going to start to come in, right? Then we're going to sort of we're going to be able to look back on the year, right, and really get a good view of it, digest it, understand it, right, and marinate for a little bit, and then try and figure out what the forward guidance is going to look like.
To the point about digestion, you and I talked every day during those Liberation Day lows. If we were to go back to Monday, April 7th, it seems so cataclysmic in many ways, but I think investors over time, they sort of learned to kind of go with the flow a little bit, not have those knee-jerk reactions to every little tariff announcement out of the White House. You have a sense that we head into the new year that the worst of those trade policy uncertainties are somewhat behind us, or still something investors need to pay attention to because they could emerge at any time?
Well, I always say we're one tweet away from crazy town with the new people on at the top of the board right now. However, I think that we've learned a lot this year. Right, we've learned, I'm so glad you brought that up, because what we did learn is not to overreact to every little tick, every little tariff response. If you learn anything from the way Mr. Trump maneuvers and and sets policy and does things, if you don't like the weather, just wait a minute, because 185% tariffs today, 9 hours later, maybe oh, he's my best friend and we're taking the ball and leaving the playground together. So and if you were to react through last year in every knee jerk, you were probably chasing the ball in an unfortunate way. At the end of the day, markets are strong, they're resilient over time. We know the S&P goes up. This is not a recommendation, disclaimer across the board. However, the market, it's a tale of the tape. The market tells us what it thinks of the information. Has it had enough time to tell us what it thinks of the forthcoming things to come in the near future? Not yet. I think we'll see it Monday, and next week will be very telling. We still do have to digest what happened with the Fed last week. So the bottom line is this: is the economy doing better than we thought? Are we looking? So already today, there was a lot of chatter like, okay, maybe only one cut next year.
Right.
I don't know how they could even be saying that, because we're just starting to get economic data that we had been cut out from, and now we're getting new data, right? That's what's going to start to happen next week. We're going to start to get the stuff that we were not privy to, and we're going to start to get things that are new data coming in, and that will be very telling.
You did an amazing job this week. Go ahead and take the weekend off. You've earned it.
You know what? Sure. I think I'm going to take a couple of days off.
The great Peter Tuchman,
Thank you,
Einstein
ladies
of Wall
and gentlemen.
Street, the
Always a pleasure.
in this beautiful institution
Boom.
of the New York
Giddy
Stock
up.
Exchange. Thanks for being here. As always, giddy up, as we like to say. Happy New Year, one and all. Thanks for being here. We'll see you next week. Skylar, I'm going to hand that to you. Bobby, you and I are going to head this way and go for a walk. Hi, everyone. Happy New Year to you. Happy New Year. How we doing? Nice to see you all. Time now to bring you the latest Poly market odds as participants are trying to figure out who is going to win the FIFA World Cup here in 2026. $41 million in total trade volume on this particular event contract. And first up is going to be Spain. Oh, thank you, bud. Pardon me. 16% odds at Spain, 14% England, 12% France, 11% Argentina runs it back as back-to-back champions, 10% Brazil. To those of you here in the U.S., sadly, only 2% odds the Americans win the FIFA World Cup. The final will be held on Sunday, July 19th. At MetLife Stadium. I know, I also can't believe it will be held at MetLife Stadium. Before we toss the break, Bobby, we'll take a look at two NYSE notables here on the day. Shares not looking great for Carvana to start the year, but what an amazing run it has been the last 52 weeks. Slow start, down 18% off their recent highs of December 12th, but 97% gains over the last 52 weeks. Considered a strong example in the eyes of many analysts of how AI can reshape consumer-facing industries. In this case, how consumers buy used or new cars. The average one-year price target sits at $446 a share. Upside potential off these levels of another 12%. And finally, Bobby, we'll take a look at shares at Caterpillar, keeping the good times rolling. It was the strongest performing name in the Dow today and the strongest performing name in the Dow throughout all of 2025. It is now the second most weighted name in the Dow, only behind Goldman Sachs. Shares of Caterpillar up 61% in the last 52 weeks. The New York Stock Exchange's very own Kristen Scholler recently sat down with Ava Kavajian of Flagship Pioneering at the Health Conference in beautiful Las Vegas, Nevada, to talk all about the future of healthcare. Take a look.
We're here at the Health Innovation Conference at the Venetian in Las Vegas, talking to all sorts of leaders about the future of healthcare and health technology. Well, joining me now here on site is one of those leaders. He's a general partner at Flagship Pioneering, Avak Kavajian. Avak, welcome.
Thank you. Thank you for having me.
I want to drill into AI a little bit more. How has artificial intelligence impacted the biotech industry to date?
Dramatically. AI has permeated almost everything we do, from the basic discovery all the way through to business processes in biotech. But I'll tell you, 10 years ago, we had already embarked on this journey at Flagship. In 2017, we founded a company called Celerity. The idea there was that cells produce so much complex biological information. What if we had AI interpret that data and then predicted which medicines could reverse disease? And that company now has medicines in the clinic. Another company we created 1 year after, in 2018, was Generate Biomedicines, a company that's using generative AI to create protein drugs. And that company too has drugs in the clinic. So AI in drug discovery has been there all along. It's only now that people are recognizing it and it's exploding.
What are the moonshots that you see in the space?
The moonshots in the space are to essentially make this faster, make this more predictable, make this go much more broad. One of the companies we just announced was Lila Sciences. Lila is using an agentic workflow where the entire scientific process of even hypothesis generation, experimental design, and conducting the experiment is given to the hands of AI. And that is allowing us to go faster, do better experiments, and do more experiments in parallel, essentially compressing the timelines for discovery. And so we're going to see more and more of those kinds of workflows in biotech, which is really compelling. Imagine, instead of doing a lot of trial and error, which is what the pharmaceutical industry was based on, doing 10 to the 9, a billion trials or 1 million trials to find the one drug, reducing that already now to about 1,000 trials or 100 trials. And I don't mean clinical trials, I mean trials in the test tube. Imagine now getting to an N of 1, essentially discovering the drug not through trial and error, but generating the drug and having a predictable outcome from that. So that's really where we're going.
And where can these innovations take us one day?
Essentially, we're going to have more medicines with fewer side effects, really imagining solutions to problems we have today with science and having a compressed timeline to getting there. So that's what we see happening.
Would you describe AI and biotech as hype or reality? Maybe both.
I don't think it's hype anymore. I think we've established that it isn't. A lot of people expect AI to succeed only if we see a marketed drug. And I think that's a logical flaw. There are many reasons why drugs fail throughout their workflow, throughout their life cycle. AI is not the guilty party if something fails ultimately in the clinic. We've already seen examples of AI generating new medicines that humans would not have thought of. And they're already in the clinic. So I think it's already here. It is not hype.
Avak Kavajian joining me here at the Venetian in Las Vegas at the Health Innovation Conference 2025. Thank you again.
Thank you.
Welcome back to the show. You're watching Taking Stock on this Friday, January 2nd, the first official day markets are open for the new year. Time now to bring you the latest headlines you need to know in the world of fintech, crypto, and AI. First up, the crypto majors all up to start things off in 2026. Bitcoin up 1.1%, but still just under 90,000 on the day. Ethereum up 4% and Solana up 3.5%. Next up, crypto ETFs are heading into the new year with regulatory tailwinds, quicker approvals, and a crowded pipeline. BTC and ETH still dominating flows as issuers brace for consolidation. And finally, at this hour, Iran moving to accept crypto payments for missiles and other weapons, according to a report from the Financial Times, as Tehran looks to evade Western sanctions. Caroline Pham joins the show now. So excited to have her. She is the Chief Legal Officer and Chief Administrative Officer at MoonPay. She joins us down here on the trading floor of the big board. Thank you for being here, and a very Happy New Year to you.
Happy New Year. It's so great to be here.
Caroline, can we start first and foremost? What are you hoping to achieve in your new role with MoonPay?
Well, what's really exciting about starting at MoonPay is that MoonPay is the most trusted infrastructure partner. It's a global value network, and I think as we see increased institutional adoption in crypto and blockchain technology for 2026, it's going to be really key that you have those partners that understand how to scale responsibly and be compliant, especially with KYC, AML, and other important protections.
Do you have an outlook for increased institutional adoption for crypto in the new year?
Oh yes, 100%. So institutions have been working on blockchain technology and tokenization and crypto as an asset class since at least 2017, sometimes even 2016. I started working on it in 2017, 2018 when I was at Citi. And so you've had the proofs of concept, you've had the pilots. All of these institutions, from the biggest banks to asset managers to exchanges and clearinghouses, have already been, for almost the last 10 years, working on tokenization and this technology. So now, with regulatory clarity over the past year, from the White House Crypto Report, which laid out the U.S. policy roadmap, to my efforts at the CFTC when I was acting chairman with the Crypto Sprint, and the SEC Chairman Atkins' efforts with Project Crypto, you are now seeing that all come together this year for institutional adoption.
Caroline, what do you think will most separate crypto companies that scale versus those that may stall and have a little bit more difficulty scaling in this new look environment?
So it is always product market fit. But with crypto, as with any emerging area where there's risks and there's a lot of uncertainty, it is going to be those who understand how to be regulatory compliant, who don't fight this idea that you do need to have protections against illicit finance, and who know how to, again, be that trusted infrastructure partner to regulated institutions, to be that brand of safety and trust for consumers. That's what's really going to differentiate. So if you're able to understand how to adapt to this environment to ensure you have product market fit and you're safe with the right governance, controls, and compliance in place, that's the winning formula.
What does the right governance look like? What does strong governance look like for the space? Undoubtedly, 2025, a ton of new momentum was put into the space, and rules of the road were changed. And everyone I've spoken to said a very favorable way, but I'd imagine strong governance is something you're probably the ultimate pro to talk about.
Thank you, I really appreciate that. So what I think really differentiates it, right, is that people used to think that you needed to break everything and have completely new rules for crypto and for blockchain technology, and that's not true. I mean, we're here at the New York Stock Exchange. When we went from paper tickets, right, to electronic screens and now to digitalization and tokenization, we didn't throw all the rules out of the road, out of the window, right? We have just rules of the road that are clear by understanding how you take securities laws, for example, and apply it to tokenized securities instrument. It's just a different format from paper to electronic to now digital. So it's the same thing. If you are able to think about the existing rules, how to apply them to the new technology, not throwing it out of the window, but just understanding how to apply it, that's the difference. And that's exactly what the regulators did last year. What I did at the CFTC and what the SEC did was to show you how you could take the existing laws and rules, use innovation exemptions, and use more flexible interpretations to take the rules that work for securities exchanges and futures exchanges and apply it to crypto as an asset class, and most importantly for tokenization and blockchain technology. That infrastructure, it doesn't change. The rules are technology neutral.
Sure. I was a Capitol Hill reporter at a time when members of Congress of both parties were really starting to learn what blockchain technology and cryptocurrency was. I think that conversation has really changed a lot since when I started down there in 2017. I wonder, from where you're situated, are there things policymakers may still slightly not understand or not quite get right about the crypto space?
Sure. I think this idea, again, thinking that crypto is breaking all the rules or that you need to start fresh, that's not true. You take what works, you use what works, and you scale from there. And so that's why, for example, with my Leverage Spot Crypto initiative when I was acting chairman, we took crypto as an asset class and put that on futures exchanges. It's worked for 100 years. It's the same thing with securities exchanges, right? Those rules have the best for investor protection, for liquidity, for capital efficiency, and most importantly for institutions. They're already plugged in. They have the policies and procedures, they have the governance, they have the compliance, and they have the risk management to use those established platforms. So I think 2026 not only being about institutional adoption, but it's about having choice. It's the choice to decide if you want to use your existing framework with state laws, or hopefully with market structure legislation having a new unified federal regime, or using the existing regime with the appropriate exemptions and interpretation. So you have the choice. You can use futures or securities exchanges, you could use potentially new platforms under the market structure legislation, or you can use your existing state platforms. It's about choice and access to markets.
Caroline, I wish I can continue with the interview. Unfortunately, I have to toss the brace. That's all the time we have. Happy New Year. Congratulations on an amazing tenure at the CFTC. Congratulations on the new role with MoonPay as well, and thanks for being here.
Thank you. It's great.
Don't go anywhere. More Taking Stock coming up after this. Welcome back to the show. Time now for the headlines you need to know in the worlds of startups, raises, and rounds on this, the first trading day of the new calendar year. First up, 2026 promises to be a historic one for the IPO market. Names like SpaceX, OpenAI, and Anthropic gearing up for potentially record-setting public offerings here on Wall Street. Next up, shares of Byron Technology more than doubling in their Hong Kong debut, signaling strong investor appetite as China races to build domestic AI chips. And finally, on this Friday, Amazon set to lead an $81 million investment in solid-state battery startup Blue Current as the company seeks to scale its electric delivery van fleet. Joining me now here on the trading floor of the big board is Wayne Pinello. He is the CEO and co-CIO of NextGen EMP, who just rang the closing bell to welcome in the brand new year. Happy New Year to you, and thanks for joining the show.
Thank you. Thrilled to be here. Thrilled to have the opportunity to bring in the new year.
Of course, and what was it like for you and the team? Amazing enthusiasm down here for the bell. What was it like to do the honors here at the big board?
It's I've been in the Wall Street business, if you will, started in commodities for 45 years, and to be honored by a prestigious exchange, the largest stock exchange in the world, and perhaps the most important financial institute on the planet. Opening day, it's a big one. It really means the world to me.
I'm a little biased. I like to call this place the Yankee Stadium of Finance. How could you not look at this place?
Yeah, I think it might even be better than that. Better track record.
Yeah, than the Yankees. Yeah, certainly.
You don't have as many bad years as the Yankees.
Yeah, no, you're not kidding. Risk is an asset. Tell me all about the book, Turning Commodity Price Uncertainty into a Strategic Advantage. What went into the book? What do you want readers to most take away?
The most important thing I want readers to understand is that as a floor trader and then as a professional manager of multi-billion-dollar accounts for energy companies, process is everything. So I patented a process that translated commodity price risk into budgetary terms, which allowed the management teams of those firms to assess how much risk they had and what they could afford to keep. Well, believe it or not, where I was just trying to help them not to lose money on their hedges, they generated over $13 billion in bottom line payments by managing the process. And so when I sold that business, I reached out into the equity world and realized in the equities, most people diversify risk away, but they don't actually manage it. And I sat down and came up with a new algorithm and started managing friends' accounts, and it just got to a point where I said, I'm going to launch this as an exchange-traded fund because I don't want to serve just wealthy people. I want all investors to have access to a product that is an institutional quality investment program. It's a long-short program that typically, if it wasn't in an ETF wrapper, you couldn't hold that in your IRA or 401k plan, but in an ETF wrapper, you can. And so it has half the risk of the S&P 500, but last year, we matched it. And so standing here a year ago, if you had asked me the question, what's going to happen in 2025, who would have expected the market's going to drop 20% between then and April, and then rally 40% to close the year up 16? With a hedge program, we dropped 7%. Because of the hedges, we didn't rally as much, but we still finished the year up 16%. So it takes all the volatility out of it, and I'm hoping that we help a lot of people by offering this to every investor, because we're only trading at $29 a share. So if you're only saving 30, 50 bucks a month, you can participate.
Yeah, of course. I'm just about out of time. I got less than 30 seconds. What is something all investors should be doing more consistently for the new year?
What they should be doing more consistently is having broad market exposure and not trying to pick winners. It's very hard to time the market. It's impossible. Take last year's example. Who would have expected that? But I would recommend that whatever your risk tolerance is, 30, 50, 70% equities, keep some cash, and if you ever get a dip like the one we had in the first quarter, then you plow in a little extra money.
That's why
but be disciplined.
That's why we always say it's time in the market, not timing the market.
Exactly. That's a great way to put it.
You've
Thank
heard
you,
that
JD.
before. Wayne Pinello, CEO and co-CIO of NextGen EMP. Congratulations on doing the honors to kick off a new year. Happy New Year.
I really appreciate you taking the time to meet me.
Great to have you. The book is called Risk is an Asset. Don't go anywhere. Much more Taking Stock coming up right after this.
Welcome back. I am Scarlett Sieber with Money 2020. And on this segment of how fintech companies actually make money, we're going to be heading down south all the way to Brazil to talk PagSeguro, the fintech that turns street vendors into digital merchants. PagSeguro started in 2006, solving a very simple problem: cash-only businesses losing sales. Their answer? Affordable card readers and a mobile app. Fast forward, PagSeguro is now a full-stack payments and banking platform listed publicly on the NYSE. So how exactly do they make money? Number one, transaction fees. Every swipe, tap, or QR code payment earns PagSeguro a cut of that pie. Hardware sales. Those portable card readers, big revenue driver for them. Digital banking. PagSeguro offers accounts, prepaid cards, and even loans, earning interest and fees. Marketplace services. Extra tools for merchants like invoicing and analytics. PagSeguro proves fintech isn't just a Silicon Valley story. It's truly global. And when you own the payment rails, you own the future of money. Have a fintech company or company in general you want us to break down? Leave it in the comments, and maybe it will make the cut. Back over to you.
Welcome back to the broadcast. Santa Claus has yet to officially come here to Wall Street. However, on Monday here on Wall Street, if the S&P 500 were to rise 0.75%, we will officially, for all time, have a Santa Claus rally to kick off 2026 for the first full trading week. Lots of Fed speak, the ADP print on Wednesday, jobless claims Thursday, December jobs on Friday. That's going to do it here for the first show of 2026. Have a great weekend. We will see you Monday.
Woo!